Well, it's flat to Boulder. And then once you get to Boulder, then the mountains actually start. And we zigzag back and forth down a road to, it's a canyon road to get up to the place. So,
right.
Hi, Byron. Nice to meet you face to face.
Hey, yeah, good to see you.
Not with kids in the car on the way to camp. Well, I'm going to give a few minutes for people to log in.
Okay.
And so we'll wait another minute or two, and then we'll get going.
Okay.
And for people dialing in, you can click at the very top. There's something called speaker view. And so what that will do is it'll make the screen larger on whoever's actually talking at that time. So it would toggle like between me and then Kim and Byron, for example. So if you want to be able to see faces, they're a little bit bigger when they're talking. So, and then we do have the chat open. So what we historically have done is we've asked people if you have a question. We do have most people on mute, but if you have a question, post it there, and then I'll be sort of watching that, and we will try to address as many of those questions as we can as well. And then after the call, if there's questions either we don't maybe know the answer to off the top of our head, or we need to follow up later, we'll go ahead and send out kind of a question answer document. So if you're logging in and you're not on my distribution list, meaning that you received the invitation to this call from my email directly, please go ahead and put your email address in the comments so that I can make sure that you're added if we send some follow-up. So. And I think mostly everybody's working. Byron, you're on mute, so if you want to unmute, you can. And then I think everyone's links are working. I'm not getting any issues that I can see, so. All right. So we do have a document with some notes, so if it feels like I'm reading at the beginning, forgive me, because I just want to make sure we're hitting all the points we want to hit. But welcome, everyone. I see a lot of familiar faces, which is awesome. And I'm actually on vacation in Arizona, which is pretty great.
Oh, wow.
So I'm in a hotel room, be jealous. But we wanted to get this information to everybody sooner rather than later. And so that's why the background looks like I'm in a bedroom. So I do have two guests today, and we have Kim, who's in the top left corner of my screen, and then also Byron. And most of you know me. I think I'm seeing a few people that maybe I don't know, but my name is Shannon Badger. I'm a partner at Badger CPA firm, which is a local firm in San Antonio, and we specialize primarily in fractional controller and CFO work. That's really our sweet spot. And Byron Bexley is the chairman and CEO of TexStar National Bank, which is a locally owned bank that began serving San Antonio in 2004. And they have a team of experienced bankers who build relationships and have customized solutions for small businesses and professionals in San Antonio. And I'll give him a chance to elaborate if you would like, Byron, or if you just want to say hi and wave so everyone knows who you are and which screen you're on.
Yeah, that's me.
So this is Byron. And then Kim Moore is a shareholder and chairman of Business Financial Group, which is a human resource consulting firm that he co-founded in 1997. BFG helps owners manage their back office issues related to their people. So onboarding, HR systems, personnel policies and procedures, employee handbook, payroll timekeeping, and then also employee benefits and retirement plans. So Business Financial Group and our firm actually have a lot of mutual clients who've been working together for several years. And so we usually partner with them on kind of the HR payroll side. So Kim, can you wave so everyone can see your beautiful face? All right. So so those are our primary guests for today. And I'm going to start off just by sort of giving a high-level flyby of some of the changes that have happened. As you all know, the rules have been basically changing on a weekly basis, it seems. And so I'm going to give just a high-level overview of kind of where we are today and some of the changes, and then we'll dive in more details after that. So the that's a tongue twister. Paycheck Protection Program, Flexibility Act, became law on Friday, June 5th. So the major issue really that we've all found is that the initial stipulations of the act, it was something that most business owners could not achieve in an 8-week covered period. It was almost impossible for a lot of industries, especially restaurant, service, hospitality, and retail. So basically they came back, and now they've made several changes to try to help businesses qualify that maybe wouldn't have qualified for forgiveness before. So the covered period has been changed from an 8-week covered period to a 24-week covered period, or ending on December 31st, whichever is sooner. So for example, if you have not received a PPP loan yet and you went to go do it today, your period would end December 31st. It wouldn't extend past that. But for most people, they can basically pick 8 weeks or 24 weeks of a covered period now. The expense ratio originally had to be 75% of your loan had to be spent on payroll costs, and then only 25% could be spent on rent, mortgage interest, utilities, etc. But they have now changed that to a 60-40 split. So now that you have a longer covered period, if your payroll costs are still lower, you would still potentially be able to spend all of the funds and meet that 60-40 split requirement. Forgiveness reductions for FTE, and this is an area we'll come back to specifically because I know it's kind of a hot point, but now they have a exemption essentially where if you're not able to return to your normal level of business activity because of COVID, you might have more flexibility in that FTE count requirement. So whereas before it was purely a percentage based on FTE before, FTE now, they are going to be basically taking into account the fact that if your business hasn't recovered by then, the odds of you having the same FTE are really not likely. So we'll come back to that one because I know for most of my clients anyways, that's a big shift. Tax deferral, the legislation now allows small businesses that have the PPP loans to defer payroll tax through the end of 2020. Prior, you could defer payroll tax, but then if your loan was forgiven, you couldn't, and it was kind of tricky. So now you have basically until the end of 2020 that you can defer payroll tax. And then the deadline to apply for loan forgiveness. The deadline to apply for forgiveness is 10 months from the last day of your covered period. So if you elect the longer period and it's the end of 2020, let's say, you have through next October to file and apply for your forgiveness. So one thing I do want to reiterate is it's not a fire right now to like get all the documentation together. I know a lot of people have just sort of this looming, loan that they just want to get dealt with. So we definitely understand that, but I just want to reiterate, it's not a fire. It's not like you have to submit all your paperwork in July. So you do have time there. And then the loan term, the legislation now has changed it where if a portion of it does convert to a loan, you have a 5-year term instead of a 2-year term. So those were kind of the main, I would say, 6 major shifts that happened recently. And with that being said, I would like to maybe shift over to Kim for a little bit specifically to talk about the 8 and 24 weeks, and then the requirement for maintaining salary, hourly wage comparisons for that period.
So, like you said, initially it was an 8-week period, and it was clear that there were a lot of business owners that were not going to be able to exhaust their funds. So they passed the PPP Flex Act, I think it was May 28th, and extended it to a 24-week period. Then they later came out with a ruling that said you don't have to go the full 24 weeks. Once you've exhausted your loan funds, then you can apply for forgiveness. I want to come back to that point about, we'll touch on it later, but there's a difference between the end date of your covered period that you select and the date you apply. Those are not the same dates. You can designate your end date and then apply any point after that and still use that historical date. One of the stipulations that's come out is, while they said you can apply early, if you have a shortfall in your either salary or wage rate as compared to the Q1, which is the look back period, if you've reduced pay for any employee below 75% for either of those, then you're liable for the shortfall all the way through the 24 weeks. So even if you apply at the 16th week, you're still going to be liable for the shortfall. I think it's important to understand how we interpret that comparison works. So most people have, the largest number of employees are hourly, and the way it's written, it refers to the hourly wage rate, and then the formula that's in the application shows you how to walk through the rate times the number of hours that you would be liable for. So basically, if your pay rate for employee A in the first quarter averaged, say, $25 an hour, and 75% of that is $18.75. So if you reduced the wage rate for that employee below $18.75, then that would be considered a reduction that you're liable for. The difference between what you're paying them and the 75% of the Q1 look back then is multiplied times the average number of hours that employee worked in the first quarter, based on each paycheck that runs then through the 24 weeks. Kind of confusing, but Shannon, does that make sense the way I said that?
I think so, but I also want to talk about, for example, I know a lot of people have a concern about once they spend their funds and then they have their FTEs now, then if it decreases later, then what happens? And I know that's different on like the actual employee expense, but you don't have to pick an 8 or a 24 week, and you can pick basically a point in time to submit your forgiveness application. And so even my firm's a great example. Like, we have our FTE count, we have already spent our funds. So I can compile my documentation, let's say as of July 17th. And just because I don't maybe get it to the bank until September, it's not going to all of a sudden say, oh, well, now if I lost an FTE between now and September, I'm disqualified from that. And now I have to redo all my numbers. So our understanding right now is that basically it's as of a point in time you can apply, and based on when it's approved or when you submit your paperwork isn't going to shift that. Because I think that's a stressor, because it kind of feels like for most businesses it's changing on a daily basis. So really you're going to be looking at your compensation for each individual and making sure it's within that threshold between when you got your loan up until that point in time. You're going to call that your cutoff. And then you're going to do all your calculation then. If the period keeps going until it's forgiven, you don't have to constantly recalculate, if that makes sense. Byron, do you want to elaborate on that from like the banking perspective?
As far as the dates being different, is that what you're referring to, Shannon?
Uh-huh.
Yeah.
Or how are you advising people? Are you saying, hey, pick a point in time, submit all the documentation, Yeah,
obviously you have to wait until you run out of your funds. And then once you do that, then yeah, you need to pick that date. But as Shannon pointed out, I think it's important to remember that your dates don't have to line up. There's nothing magic about that. You can have a date that you pick as your end date for your covered period, and your documentation needs to run up to that period of time. And I think we're going to talk a little bit about the documentation a little bit more later on. And so, like Shannon said, if you wait 2 months, however long you wait, as long as you're within that 10-month window to apply for forgiveness, then it doesn't matter. So the dates do not have to line up, and there's nothing magic about them lining up. So you're right.
Well, and also what Kim was talking about, the 25% reduction amount. So for example, let's say you're an employer and you had to reduce everybody's pay by, let's say 30%. To get within that 25% reduction, Kim, my understanding is they're basically going to be looking at the pre-COVID timeframe, whatever their kind of annualized regular comp was. So let's say somebody's making $1,000 a week for math purposes, and then you get into your covered period and you had reduced their pay by 30%. They're going to be looking at the average over that covered period if they're back within that 25% reduction threshold. Is that correct?
So you're saying if there's variability or a variation within the covered period, you started them out at one rate and then you corrected that. I think you'd have to look at the average rate, because that's what you're comparing to. It doesn't say average, but you're comparing your look back as an average in the first quarter. So I think the key in terms of planning is when you pick that, when you start to hone in on the date that you want, if you're going beyond the 8 weeks, if you're going to do it all within 8 weeks and you've got no reductions on FTE or look back pay, then you're probably good and you could wait for months to apply. But if you go beyond that and you've got some some numbers that are changing in terms of FTE or your wage look backs, you want to make sure that the date that you select, that it's all kind of aligned at that point. So run your averages, and I think you have the advantage then to continue to let payrolls run and make sure that is the optimum point in time. But you don't want to leave that point and get 2 months down the road beyond the point when you can fix it. So anyway, I'm getting into strategy, but I think your point about average is correct.
There's a couple questions now. So out of that, there's two things I want to talk about. So one is a change in somebody's rate, meaning we used to pay you $15 an hour, or we used to pay you $20 an hour, and now we're paying you $15 an hour. So that's an actual reduction of rate where they're looking at that 25% threshold. But what if it's somebody's same pay rate, but you've just reduced their hours? So does it still fall into the 25%? We used to be able to have them full time, but now we can only have them, half time, for example. And I know that affects your FTE count, but for that 25% threshold for that employee, how does that impact it? Since their rate is the same, it's just their hours have decreased for hourly.
So it's a good point. And when we first started running the programs in our payroll system, we were looking at total pay because we thought that's what they were focused on. And then as we began to review the application, you realize that it's not the total for the wage look back. It's not the total pay, it's the wage rate. And your hours could have been reduced by half, and you still don't have if you're within 75% of your average pay rate, then you should still be good. But like you said, if you're paying half hours versus Q1, then your FTE or your lookbacks, then your FTE count is going to be low. And so I think they were trying to not double penalize you.
Well, exactly. And that's one thing we had talked about was, if you're already paying people less, you're going to get hit on this 25% of pay issue and your FTE issue. Like, it's going to hit you on both tests. And so I think basically as long as their pay rate has stayed the same, it's only been an hour reduction, it won't count against you for the 25% rule, but it would count against you for the FTE rule. That's where we are interpreting it now. One other question was, what about basically your employee mix or your payroll groupings? Meaning, like, what if you had a director of marketing that was making more money and then you decided, well, I'm going to eliminate that role and then hire maybe a more entry-level role? How does that affect things? My understanding is, well, your FTE is the same. So as long as you spent your funds on wages, I think you can change your role, basically mix within your company without having a penalty. But what is your understanding or feedback about that?
So there's nothing that we've seen that would define, you know, or give parameters for, and Byron might be a better person to answer this question, but we haven't seen anything that says that you have to defend that. So in other words, you're going to terminate that director of marketing and hire somebody at a lower level. So you made a termination. It wasn't for cause. It was presumably it was either a financial matter or it was a strategic realignment. I would think you would want to be able to justify that decision as a strategic matter to the bank.
Yeah.
Yeah, I'd agree with that. I would also add, it's a very minor point, but for the purposes of our discussion, when we're talking about employees, reduced salaries, all that stuff here, if there's a little weird deal in the reg that they've written is that it doesn't pertain to employees that made more than $100,000 in 2019. They're not counted as an employee as far as those calculations go. So if for some reason you lowered the salary of someone who was making more than $100,000, that would not fall into this category that we're talking about.
So if someone made 150, now they're making 120, for example. So kind of your higher level employees, if you reduce their pay, it doesn't account against you.
No,
in any way, shape, or form.
It doesn't.
No, that's a good point. And I want to take a second. So for full-time equivalent, just so that we're defining that, right now per the loan forgiveness application, it's defining that as employees who average 40 or more hours per week count as one FTE. And then for employees who work on average less than 40 hours per week, you can do one of two things. One, you can take their total hours and divide it by 40 to get an FTE equivalent, or you can count each part-time employee that works less than 40 hours as half of an FTE, which they're calling that a simplified method. So basically, if you have people that are working less than 20 hours a week, it's going to benefit you to use the 0.5, basically because you'll be able to pick up maybe a little bit extra there. Or if you have some that are working 25, 30, 40, you can basically add up all those hours and then divide by 40, because that would be more advantageous if your people generally work more than, half, basically, more than 20 hours a week. For employers who had used the definition before, which was 30 hours instead of 40 for the look back periods, we don't think it's going to significantly impact the numbers, basically, because it's a percentage. So whether you're using a 40 or a 30, it's probably going to look about the same. But that was a clarifying definition that they came out with about a month ago. So what if the number you estimated on your original loan application is based on a whole different formula? Byron, can you, I know some people applied with like one definition and then everything changed after the fact. So what are you recommending there?
Yeah, initially we actually even sent a sheet out to all the people that borrowed saying, this is how many employees you said you had, thinking that it was going to have some bearing when they applied for forgiveness. Well, the reality is it doesn't. There's no standing in that. I think ultimately what the SBA was trying to achieve there was get employee counts and maybe number of jobs being saved and that sort of thing. But the reality is that those numbers don't have to match. So when you calculate, you want to go ahead and use the calculations that Shannon just referred to as far as calculating employees, and really, as long as you have not had a change in that, you're okay. Okay.
And I did have somebody post asking about if there's documentation to fill out yet, because their bank said it wasn't available yet. And the forgiveness application is available online. I can post it in the comments. So the application forms for forgiveness are out there. And that's helpful because there's actually a long form and a short form. And I'll let Byron dive into that more. And I'll post the links below. But can you talk through, Byron, basically what's available to fill out now? Where can they find it? And then the documentation that they need to start pulling together.
So there's two forms right now. There's the form that was originally presented, and I think it's 5 pages long. And then they came out with an easy form after that, and it's 2 pages long. Basically, the short definition is you have to fill out the full form if you don't qualify for the easy form. In the easy form, there's 3 questions. I'll probably read these because it's easier just to read them, but there are 3 questions that they have. Question number, you have to be able to answer yes to at least one of these, and that is, the borrower is self-employed individual, independent contractors, or sole proprietor who had no employees at the time the PPP loan application and did not include any employee salaries in the computation average monthly payroll on borrower application form. So that's simple, self-employed, independent contractor, or sole proprietor. The second question is the borrower didn't reduce the annual salary or hourly wages of any employee by more than 25% during the covered period. I'm not going to read all this to you. And then there is an exemption, which I think we're going to talk a little bit about. There's an exemption if you try to rehire and we're not able to rehire, or and then also I think the third question pertains to, it says the borrower did not reduce annual salary or hourly wages of any employee by more than 25% during the covered period or alternate period compared to the period between January 1st, 2020 and March 31st, 2020. And then it says that the borrower was unable to operate under the covered period at the same level of business activity. That's the other exemption that is granted out there, and that would say you were shut down because the city had locked down, or CDC had issued something, or the state had issued something, or local health authorities, that sort of thing, had it issued something. So if you can answer yes to any one of those 3 questions, you can use the easy form. Now, I'll tell you what we're actually encouraging our borrowers right now to wait. And the reason is because floating around in Congress right now, there's another form. One thing you can count on PPP is that just hang around for a week and things will change. Usually on Friday night, that's when the SBA drops their information. But there's another one floating around right now that any loans that are $150,000 or smaller, which really comprises about 85% of the PPP loans that were made nationwide, there's going to be a 1-page certification form that you basically check a couple of boxes and sign it, certifying it. You will still, as our understanding, you'll still have to provide the backup data that we'll talk a little bit about, but that form is going to be a simpler, much simpler form, and probably not have near the investigation, if there are any investigations by the SBA on them.
Well, let's go back, as you mentioned, let's talk about, so if your FTE count in the covered period has gone down from the look back period, what does that look like? Because I know there's some exceptions now, basically, for that impacting. And I don't know if Kim, if you want to hit on that first, and then Byron. But basically, if your FTE count is low, now there's certain exemptions and requirements where you might not be completely penalized for that FTE count.
Yeah, I think Byron's going to touch on the